Do you know that Indonesia is the best performing ASEAN bond market in first half of 2023? The Indonesian bond market always comes up in conversations because of its attractive yields. So today, let's learn more about why the Indonesian bond market is attractive and know what are the opportunities there. Hello, welcome to another RHB Treasury podcast. I'm Chris Tan, Fixed Income Strategist at RHB Banking Group. Indonesian government bonds, or simply Indo bonds, attracts a lot of interest due to one obvious factor: high yields. Indo bond currently offers yield to maturity of 5.8% for 2-year, a 6.24 for 10-year, and a 6.76 for a 30-year bond. Government bonds are the safest investment from a local currency perspective. Also, Indonesia also offers plenty of sukuk for those looking for Sharia-compliant investments. And as usual, we need to take into consideration foreign currency fluctuations when investing in foreign currency denominated assets. Currency positioning is a different topic, which we shall not discuss this time. Indo bonds generated 6.8 return in first half of this year, while Malaysian government bonds returned 4.1%, Thailand returned 3.2%, and Singapore returned 1.5%. So, why did Indo bonds perform well in the first half of 23? The key reason is because yields went down significantly in the first half of 23. Bond yields were high at the beginning of this year because investors sold off the bonds because of the rising interest rates, as bond prices move opposite to bond yields. However, when inflation began to slow down in Indonesia, and with that, the Central Bank of Indonesia began to pause rate hikes. And that signaled that interest rate has peaked and will not go higher than previously expected, and investors began to buy Indo bonds aggressively. Yields for the 10-year and 30-year Indo bonds fell by 67 basis points and 49 basis points respectively in the first half of 23. A rally in yields will boost bond prices. But as any fixed income investor knows, there's coupon returns as well. Compared to its ASEAN peers, Indo bonds benefited from its high coupon returns. Coupon returns generated 3.48% to its total return, while the rally in bond prices generated a lesser 3.19% returns. High coupon returns will also help shield bond investors from a bond sell-off, such as in 2022, where despite Indo bond prices falling by 3.56%, the coupon generated returns of 7.26%, which completely offset the losses in bond prices. Moving forward, we have changed our recommendation for Indo bonds from overweight to market weight, given the strong year-to-date rally and a lack of catalyst for yields to tighten further, as recent global market developments suggest that the labor market in the US remains resilient, which may lead to the US Federal Reserve to further hike interest rates, which could affect demand for Indo bonds. A market weight recommendation means that investors should continue to hold on to this sector with a neutral or balanced allocation. On a balance of risk perspective, the high absolute yields and a moderating inflation and growth outlook in 2023 and 2024 could lead to yields going lower. Also, a structural downshift in the Indo bond yield curve could materialize in the near future as the economy matures. So, there you have it. This is all we have for today. We hope you enjoyed this podcast and see you next time.